March 3rd, 2020. The Federal Reserve does something it hasn't done since the 2008 financial crisis. It cuts interest rates in emergency between scheduled meetings, half a percentage point. Gone. The announcement lands at 10 a.m., stocks bounce, and then immediately keep falling. A week and a half later, the Fed does it again. Rates go all the way down to zero, and still the market is in free fall. Businesses are closing, people are losing jobs by the millions. The most powerful central bank on earth is pulling its biggest lever, and almost nothing is happening. Why? That's what we're gonna unpack today. I'm Dylan, and on today's episode, we're asking what can Federal Reserve actually do in a crisis? On what is its was it fundamentally powerless to fix? The short answer might surprise you. The Fed's main tool, interest rates, is essentially a demand-side instrument, and what COVID-19 created was a supply-side shock. Pulling the lever, no matter how hard, doesn't move the right machine. Let's dig in. So let me start with the core idea of Chapter 7 of Limitless by however you say that. The limitations of traditional monetary policy and why interest rate cuts can't fix a pandemic. I want to be really clear here, so I'm going to explain this in plain English. No economics degree required. Think about the Fed's primary job in a recession. Normally when the economy slows down, people stop spending. Maybe they're worried about their jobs, maybe confidence drops, maybe credit dries up. Whatever the reason, demand falls. People and businesses want to buy less stuff. The Fed's response to this is to make borrowing cheaper, cut interest rates, and suddenly it's easier to take out a mortgage, a car loan, a business line of credit. Companies can borrow to hire more workers. Consumers can borrow to buy homes. Demand comes back. The economy recovers. That's the textbook playbook, and it has worked pretty well for decades. But here's where COVID breaks the model completely. The model in March 2020 wasn't that people were afraid to borrow. It wasn't a demand collapse, at least not in the traditional sense. The problem was that restaurants were physically closed. Factories were shut down, airlines were grounded, supply chains were severed. You can make borrowing free, literally 0%, and it doesn't matter if the restaurant can't open its doors. The workers aren't coming back because the loan is cheap. They're not coming back because there's a global pandemic and the government has told everyone to stay home. That's the mismatch at the heart of what happened in March 2020. The Fed had a demand-side tool, and it wasn't facing a supply-side crisis. That's the question that Powell and his colleagues were wrestling with, and it gets to the core of what central banks can and can't do. They're extraordinarily powerful in the right circumstance. In the wrong circumstance, they're pulling on a string.
Alright, let's get into the actual mechanics. How does cutting interest rates normally work, and where exactly does the chain break down? So onto mechanism 1, the monetary transmission channel. This is the official name for the process by which a rate cut actually reaches the real economy. Pictured as a chain with about 5 links. So that's what I drew. Not really a chain, but more like a step-by-step process. So it starts with the first link, which is the Fed controls, and it's the federal fund rates, which is the rate at which bank lends to each other overnight. When that rate drops, it ripples outwards to mortgage rates, auto loan rates, and corporate bond yields all tend to follow, which is the next step right here. The cheaper credit flows to businesses and consumers who spend more, which then boosts the growth, which is the third and fourth one, which leads to a GDP growth. So here's a critical insight. This chain only works if the bottleneck is the cost of borrowing. If people aren't spending because money is tight, cheaper money fixes the problem. But what if people aren't spending because there's a virus outside and the government has told them to stay home? In that case, you've broken the third link in the chain. Households and firms are constrained by credit costs, but they are constrained by public health emergency. Cheaper loans don't remove that constraint. They don't reopen a factory, they don't bring a tourist back from overseas, and they don't unclose a restaurant. The book directly notes this by saying how the lower rates would make it slightly cheaper for companies and consumers to borrow, and it might reassure markets that the Fed was actually paying attention. But it was hardly a cure-all. Now on to mechanism 2. market plumbing, and why it matters separately. Now here's something that even most financially literate people don't even know. While rate cuts were failing to stimulate the real economy, something else terrifying was happening underneath the surface. The financial markets themselves were breaking, not just stocks falling, that's normal in a crisis. I'm talking about the fundamental plumbing of global finance seizing up. US Treasury bonds, the safest, most liquid asset in the world, became very hard to sell. So I drew a graph to break down the March 2020 market plumbing. On the bottom it states the sequence of market contagions, which is like the what happened after this event and so on. And over here is the intensity of financial system stress in percentages. To start off, the pandemic was announced, which brought the stress to around 10%, and that leads to investors rushing to sell everything they had. And this creates a sudden massive demand for cash that the system isn't prepared to provide instantly, which leads the stress to go up to 30%. Next up is the money market funds face mass withdrawals, which leads to a modern bank run. The modern bank run, where the primary source of short-term funding for the economy begins to dry up, which leads the stress to go up to 50%. After that, funds stop buying commercial paper, which leads to a short-term company debt. Companies lose the ability to pay daily bills or payroll because the short-term debt market stops functioning, which leads the stress to go up to 70%. After this, companies can't roll over short-term borrowing, which leads to a cash crunch, and now hedge funds dump around $90 billion in treasuries to raise cash, raising the stress to up to 90%. Last up, the treasury market, the backbone of global finance, seizes up. And this just shows how rate cuts cannot fix broken market plumbing. The Fed needs a different set of tools entirely. So the Fed was actually fighting a two-front war. On one front, the real economy, where rate cuts were ineffective because the shock was supply side. On the other side, the financial system, where the basic machinery of markets was breaking down in ways that required completely different tools: emergency lending facilities, asset purchases, and liquidity injections. The chapter describes the situation pretty vividly. It states how, over a short 48 hours, markets began to fall apart. It describes how what had looked like an orderly withdrawal from money market funds began to look more like a modern version of a bank run. Companies were losing access to short-term funding, hedge funds were dumping treasuries, banks were being squeezed by regulatory capital constraints. This is why the Fed's March 3rd rate cut landed with a thud. Markets were watching for reassurance. What they got was a tool designed for a different problem. It would take weeks of increasingly aggressive and creative intervention before the financial plumbing was genuinely restored.
Okay, on to the data story. Let's look at some actual numbers because the data is genuinely crazy. So, according to the Federal Reserve Bank of St. Louis public data portal, we can see that on March 3rd of 2020, the Fed cuts the federal rate from 1.75% to 1.25%. That's a half-point emergency cut, the first since 2008. The rate had been sitting comfortably above 1.5% throughout the entire previous year. 12 days later, on March 15th, a Sunday, the Fed cut all the way down to zero. Essentially abolishes the cost of borrowing overnight money. Rates go from 1.75% in February to essentially 0% by mid-March. This is an extraordinary, historical, unusual move. Now let's look at the GDP. What happened to the economy after? Let me say that again because it bears repeating. The Fed cut rates to zero and the economy still contracted by 31.4%. In the second quarter of 2020, the single worst quarterly GDP collapse in U.S. history was recorded, worse than the worst quarter of the Great Depression. Now, to be fair, nobody argues that the rate cuts made things worse, and there's a reasonable argument that without them, financial conditions would have tightened further and the recession would have been even deeper. The Fed was right to act. But here's the point. Rates going to zero could not substitute for fiscal intervention. It could not substitute for the Paycheck Protection Program, which kept millions of workers on payrolls. It could not substitute for the stimulus checks Congress sent to households. It could not substitute for the expansion of unemployment benefits. The rate cuts bought time and kept credit markets from freezing entirely. But the real economic rescue came from somewhere else. From Congress and the Treasury. The Fed was necessary but not sufficient. Okay, busting the myth. Let's address the big misconception head on, because I hear this one constantly and it's genuinely important to get right. So the myth is that the Federal Reserve can always stabilize the economy if things get bad enough. The Fed cut rates, print money, does whatever it takes, and eventually the economy recovers. This belief is so widespread, it almost goes unquestioned. It's baked into how financial journalists write about crises. It's baked into how market price risk. When things get scary, investors ask, what will the Fed do? As if the Fed is the answer to every economic problem. And look, that belief isn't crazy. Coming out of the 2008 financial crisis, the Fed's interventions were genuinely remarkable. Ben Bernanke's Fed deployed emergency lending programs, bought trillions of dollars of assets, and kept the financial system from collapsing. The recovery was slow, but the system held. That experience reinforced the idea the Fed can fix it. Here's what the narrative gets wrong. 2008 was fundamentally a financial crisis that spilled into the real economy. The shock originated inside the financial system, from collapsing mortgage-backed securities, from over-leveraged banks, from a credit bubble bursting, and the Fed's tools, emergency lending, asset purchases, rate cuts, and very well designed to address problems that originate inside the financial system. Because those tools work through the financial system. 2020 was the opposite. The shock originated outside the financial system, from a virus and then cascaded inwards. The real economy was hit first and hardest. Small businesses closed, workers lost incomes, supply chains broke, and the financial disruption was a consequence of that real-world shutdown, not the cause of it. You cannot interest rate cut your way out of a pandemic. You can stabilize financial markets, and the Fed did. Heroically, there was an emergency lending facility. You cannot use monetary policy to reopen a restaurant, put a nurse's PPE back in stock, or reopen a school. That's a remarkable thing for a Fed chair to say publicly. He's essentially admitting we pulled the lever. We know it's not the right lever for this problem, and we're doing it anyways because it's the only lever we have right now, and we hope Congress will use this lever soon. The corrected version of the myth is that the Feds are extraordinarily powerful in demand-side downturns, where the problem is that people and businesses need cheaper access to credit. It is far less powerful and sometimes nearly irrelevant. In supply-side shocks where the constraint is physical, not financial.
Let's close with the big picture. What should policymakers and citizens take from all this? Takeaway 1. Match the tool to the type of crisis. The most important lesson from March 2020 is that the nature of the shock determines which policy tools are effective. If the problem is demand, people aren't spending because credit is tight or confidence is low. Monetary policy works well. The Fed has decades of experience and real credibility here. If the problem is supply, a pandemic, a natural disaster, a war disrupting trade, you need fiscal policy first. Direct government spending, transfers to households and businesses, programs that put money in people's pockets or keep workers attached to employers. Rate cuts are a supplement, not a substitute. The dangerous scenario is one where policymakers use the wrong tool and then wonder why nothing is working. Or worse, declare the crisis intractable because the tools they're comfortable with aren't producing results. The chapter captures the institutional tension perfectly. At the Fed, officials did not want to repeat the mistake of saving Wall Street as the rest of America was left hanging, hoping that enough help would come from the rest of the government. The book notes that in 2008, Congress had been debt, worry, and divided, passing spending packages too small for the job at hand, and leaving much of the rescue to the central bank. Takeaway 2. The Fed's real superpower in a pandemic isn't rate cuts. It's being the lender of last resort. What the Fed ultimately did in March 2020 that actually worked wasn't cutting rates. It was deploying a suite of emergency lending programs, backed by its rarely used Section 13(3) authority, to unclog the financial plumbing. The Commercial Paper Funding Facility, the Money Market Mutual Fund Liquidity Facility, the Primary Dealer Credit Facility. These programs bought short-term corporate debt, stabilized money markets, and stopped the financial system from seizing up completely. That's the Fed at its best, not trying to simulate demand that doesn't exist, but preventing a financial crisis from making an already terrible real economy shock catastrophically worse. It's a supporting role, not a leading one, and understanding that distinction matters enormously for how we design crisis response going forward. Takeaway 3. The coordination problem is the hardest problem. The final lesson is about institutional design. The Fed can act fast, shockingly fast, as March 2020 did demonstrate. Congress is slower, messier, and more politically constrained. The result in a fast-moving crisis is that the institution that can act quickly will act, even if its tools are imperfect, while the institution with the right tools moves slowly. That's a problem, because the faster we can get fiscal relief to households and businesses in a supply-side shock, the less damage the shock does, and the less extraordinary monetary intervention is needed to stabilize financial markets in the aftermath. The book's account of Fed Governor Lael Brainard walking through Frankfurt Airport in early March, watching travelers from around the world and realizing this thing is going to spread, before getting back to Washington and telling colleagues, this is going to be bad, is a reminder that the people running these institutions are not omniscient. They're reading the same signals we are, just with more data and better economists. The question is whether our institutions are designed to respond fast enough when those signals come in. That's the question March 2020 left unresolved, and it's one we're still working through. So, to recap, the Fed cuts rates to zero in March 2020, and it still wasn't enough. Not because the Fed failed, but because rate cuts were the wrong tool for a supply-side pandemic shock. The right tools were emergency lending facilities to fix broken market plumbing, and fiscal policy to support households and businesses directly. The lesson for the future: match the tool to the type of crisis. Build the coordination machinery before you need it, and be honest, as Powell was, about what central banks can and cannot do. This episode drew on Chapter 7 of Gianna Smialik's book, Limitless, which I cannot recommend highly enough if you want to understand how the Fed actually works, told through the real-time drama of the people running. Links in the show notes. If you found this useful, please share it with someone who thinks the Feds can fix everything. It's a gift they didn't know they needed. I'll see you next time.